All right, welcome to the Everyday Investor, Ryan Johnson-Hunt. How are you?
Very good, thank you. Very good. Yeah.
Fantastic. The whole kind of reason why I wanted to catch up with you is that I've heard through other conversations I've had on the podcast and just heard generally that concepts like real world assets and tokenized assets on blockchains and all this sort of stuff, which feels really, really far away. It feels really futuristic. We have traditional finance, like legacy finance, if you like, and then we have decentralized finance, or the future of finance, and then we have this transformational period in between, which I feel is where that new frontier, that's where the action is, that's where the uncertainty is as well. So let's break down what is already, just so that people can understand some of what we're going to be talking about today. And let's start with the term capital markets. What does capital markets mean?
Capital markets is a place where it brings together two groups of people that have some excess money, aka capital, that they want to put to use. And then another group of people who want to do fun, exciting things, whether it's a company or fund or whatever, and they want capital to help drive that. And so in this purest sense, it's this connective tissue between people that have funds to be productive and people that will actually do the work to make those funds productive. Throughout history, that has been a paradigm that's worked in various different ways and forms. I mean, the London Stock Exchange has been around for 220 years based on that type of thing. And then I guess the other piece of that at the moment is because there's always some kind of delay between when an investor pays money and when they receive the paper version or the electronic version of what that is. That's kind of what we call a settlement time. And so, historically, that could have been months if things had to come over from a ship or something like that. These days it's down to about 1, 2, maybe 3 days, depending on the asset. And so because there's this delay in settlement between the two parties, you need to have some really robust systems in place to make sure it all works. Otherwise, you've got counterparty risk, which is one side says, yep, I'll do it, and then they just never pay. Or they take your money and then never give you the asset. And so you've got this entire, it works quite well for what's needed, this third party in the middle to kind of guarantee that sale, a clearinghouse. And then you've got entities like custody that will hold that money. They're like a neutral third party, like the Switzerland of it, and they hold the money, and then when the asset goes, they transfer it. And then, of course, you need some group to be able to keep track of who owns what. That's kind of some kind of a share registry service. So all these pieces are actually really, really important in the current system because they make sure that everyone has confidence in the market as a whole, and people won't do business unless they feel like they've got protections.
And so when we talk about the legacy financial system, these are some of the participants, right?
Exactly.
Registry services, custodians, clearinghouses. And a lot of their existence is necessitated by the fact that there's a delay between when something is purchased and when something is delivered. Really, right?
And there's a lot of trust. So in the legacy world, if you don't have trust, then you need to put things in place like custody, and you've got things like contracts and all kinds of things to try and build trust in the system to give people trust. Whereas, kind of foreshadowing the future conversation we're going to have, moving to a model of trustless transactions where things are in code rather than on a piece of paper with a signature, that's kind of where the paradigm shift is.
Okay. So I guess thinking about this in terms of going to the farmer's market, you've got your currency, you rock on into the farmer's market, you trade your currency for the goods. It's instantaneous and like literally transparent because you're often using cash. Whereas as soon as you're in the financialized layer, it's really difficult because you're dealing with numbers on a screen rather than actual tangible bits of money.
Exactly.
And also the thing that you're buying is a representation of something else.
Exactly.
It's not like if I'm buying shares in a company, I'm not literally buying a seat at the table. Figuratively, I might be a small slice of a seat, right?
Yeah. And that also presents another problem, because over time, what has happened, by over time I mean like hundreds of years, is you get these kind of more abstraction of value, and you'll hear the term like financialized kind of markets, and you kind of get these kind of domino effects where you build products among products, and it gets to a point where the actual what's underlying it has actually been completely disappeared and no one knows. That's where you get all kinds of things like the 2008 global financial crisis, is you haven't got this transparency of who owns what, and actually they didn't actually know who owned what until it all came tumbling down.
Right.
And so there's a challenge there to try and stop, that if there's a way to create abstract financial products and sell them, that will happen. So there needs to always be kind of work done by regulators, God bless their souls, to help kind of protect the investor from that.
Sure. Yeah, let's say it was the 2008 global financial crisis, where there's layers and layers and layers of subprime debt, which becomes really hard to dig. And you can't see exactly what the credit quality is, because you have no idea that you're actually dealing with a stripper from Toledo or a builder in Ohio. And what is their capacity to repay under certain circumstances? So how could you ever make that assessment? But that vagary, I guess, gets compounded when there's products that sandwich it all together, and then there's derivatives upon that, right?
Exactly. And so the collateral, the actual asset underlying it that kind of secures the loan, sometimes gets hidden below layers of other stuff. And so generally speaking, you want to kind of know where the collateral is, because when it hits the fan, that's what matters.
And it will eventually, given enough time frame. Like, I guess with your real world experience in dealing with people, explaining these really futuristic concepts to people, do you find like your education that you had, your formal education in finance in particular, did that actually help or hinder you? Or did you always need to translate that when you're learning it?
I think it's been a double-edged sword, because I know enough to be dangerous, but I know enough to say, okay, there's a huge opportunity to kind of disintermediate all these players. Like, the more I learned about the capital markets, the more I understood how blockchain could solve some of these things. But I don't know enough to realize how hard it is because it's been tough. And even in the last kind of 8 to 10 months, like roadblock, you either bust through it or you just like go around it and find another way. So it's been it's quite good. And from an outsider, I can sometimes see things from a different angle, but I know enough not to ask stupid questions and kind of be a nuisance. But I mean, it's all about people, like you said. We've had people in our camp from day one. Brian Ventura has been on your podcast, Rachel Jemming from EY, and they've kind of believed in this project and helped drive it in the very early stages, where it was kind of, it's like a spark, waiting for a little bit of oxygen. And now we're at the point where we've actually cracked through the hardest obstacles, the regulatory compliance side of things, and all those things that would generally stop. I mean, all startups are hard. All startups are hard. Fintech startups are especially hard because there's so much that needs to go into just going live. You can't go live and kind of wing it like you can if you've got a website or e-commerce and things like that. You can start ugly and make it better. If you start and break compliance rules, you get shut down.
That's right.
So it's a little bit more tricky.
It actually has to be perfect from a regulatory point of view. And even then,
lots of scrutiny.
So it might, even perfection might not even be good enough. And so that getting that idea started, and then to the stage where you're at right now, and we'll dig into this more as we go, but just to even get it started, not exactly why we're talking about this today, but just from a startup point of view, what was the first sort of big break in terms of like the funding aspect of this? Did you get early stage investment which allowed you to get to the stages that you needed to fast enough, or did you have any hurdles around that?
we didn't get funding.
Wow, really?
Yeah.
Okay.
So, bright-eyed, bushy-tailed pitching to VCs and things like that, but at a point where it's very much a concept. And I see where they're coming from. They've probably had people pitch these types of things all the time, but it's actually hard to execute. So it's usually either we're not interested because we don't touch anything blockchain related, fair enough, or it's come back when you've got something live that we can see that you've got approved from regulators when you've got through the worst of the hurdles. So a lot of bootstrapping and keeping costs really, really low. As much as at the time it would have been great to have someone write out a big check, the reality is it's forced us to really think and actually evolve our product a lot.
Yeah.
Well, the first product we're going to be launching is a product that helps start, early stage companies raise. So we're going to be doing that for ourselves to kind of be the guinea pig of that.
Yeah.
And it's kind of putting a traditional investment vehicle wrapped in a basically tokenizing it and putting it on our platform.
Yeah.
So if it's successful, and it seems like it will be, all systems go at the moment, then that can be that packaging can be used over and over by other people in our shoes to help connect like Kiwi angels and small time, investors with small startups that are doing interesting things. So, it could be that it became one of our greatest kind of opportunities, and we wouldn't have had that if we just had someone write out a check. So it's an opportunity for New Zealand, central government, whatever you want to call it, to kind of nurture innovation better, because it is so hard as a founder. The only way you get there is if you just have the grit to stomach a level of risk that most people make most vomit. But it shouldn't be that hard to innovate something. And I know that for every person that goes through that journey, there are 5 others that actually have really good ideas that for whatever reason, their personal situation, they can't actually dedicate that guts to. But those are things that could put New Zealand on the map. And so I think we need to do a better job at helping nurture innovation.
Okay. And so talking about the current legacy system where we have a marketplace and there's risks, there's players like custodians and registrars and all sorts of stuff going on in between. Sometimes there's a little bit of murkiness, which gives investors a little bit of pause, especially if they're just getting started, because it feels like you're understanding or you're trying to understand a whole new language. But ultimately, you can build wealth one of 2 ways in New Zealand, more or less: property or business. So if you don't have the money to get started in property, it might be easier for you to get started in business, but you might not be able to start your own. Therefore, you can invest in other businesses, and you can invest in those businesses at very, very early stage or a very mature stage, depending on where you're at. And the whole the thing that I think is the coolest thing about investing in businesses is that is underlying, that is what economic activity is
exactly
in our country, right? And so it's important as a nation that we have growing businesses and we have money that's moving around the system, investing in productive things rather than just sitting still in people's houses or bank accounts. It needs to be moving around. If we don't have an environment, and this is more of a high level question, I guess, but if we don't have an environment where money is moving around an economy and startups are getting an opportunity to get their ideas out there in the open, what begins to happen?
You just get stagnation, and you get kind of big monopolies with sometimes overseas companies gobbling up the mum and dad type of store. And then you kind of get consolidation, you get less choice for consumers, and then you get kind of a little bit too much concentrated power. Often when we talk about startups, we think of kind of like sexy startups. It's at its heart just small businesses, Kiwis running small businesses, from the local dairy to builders to plumbers. That's actually the lifeblood of the economy in lots of ways, or maybe should be a little bit more. And it's kind of like the boring businesses. It's like the service-based ones, the laundromats and things like that. And it's creating economic value and putting money on people's table and solving problems. And like you said, that's the moving out of money that you want more of. And one of the challenges is that in New Zealand, banks have a lot of power in that space and not that much competition, really. And there's a huge gap between having a very small company or small business through to where you're at the size where someone like the NZX can help you grow. So for those that don't know, the NZX is New Zealand's kind of national stock exchange. If you want to take your private company public, there's a process of being able to have people look through, make sure that the company is doing everything it should be doing, there's no skeletons in the closet, and that process is very costly. And then listing on the exchange, and that allows everyday people, like you said, that don't have enough money to start their own business or buy their own property, but they want to buy pieces of other businesses, shares, to buy pieces of those, whether it's Fletcher's building or Air New Zealand or whatever. The problem is that the costs of listing on the NZX, not only one-off but recurring, are so high that it's only really available for a big company that wants to get even bigger.
Sure.
Whereas small companies that want to get to medium-sized companies and medium-sized companies that want to get bigger, but that's just not a viable option. So we're hoping to be more in that space and solve problems there.
Okay. You mentioned monopoly, less choice. There's a concentration of power.
Yep.
You kind of just described the banking scene, really, haven't you? But that's kind of what happens over time when money stagnates, right? Like when it forms pools, it doesn't water all the field. And unfortunately, though, that is a trend that we kind of see everywhere, right? Like things get bigger. Even Amazon just gets bigger and bigger and bigger. And I guess you create this feedback loop when we're investing more in just a few companies. We're empowering just a few companies to get bigger and bigger and bigger. So the whole system is set up for bigness and consolidation. Therefore, I guess what I'm saying is that there's probably a widening opportunity as well, but you have to be quite careful to target those opportunities in areas where you're not going to be butting up against those monopolies. So in the area of finance in particular, where it is fairly well established, do you feel like the moat that traditional finance has created is impenetrable? Or do you feel like there's certain areas where their guard is down because of hubris or something else?
When it comes to competing with the big boys on their territory, no chance. Like, why would Air New Zealand list on us when they've got so much liquidity and so many buyers available, on a big exchange? So as a startup, as a disruptor, your opportunity is to get the low-hanging fruit that isn't being looked after by the traditional system. So all of those little companies that are desperate to get capital to grow, so they need some money to open a new plant, or they need some money to expand operations overseas, they are desperate for that. We've found that over the last few months is that we get lots of inbound leads from those companies. Hey, I read your magazine, or I was talking to so-and-so, and we have those leads coming in. So we know that demand is there. And then we also know, as you said, that those small companies or the medium-sized companies, it's riskier because some of those won't get bigger or some of those will go under. But a certain number of them will grow really quickly. And so they're definitely further up the risk curve. If you buy into a publicly traded company, one of the big players, in a best case scenario, they might have a really good year and you might get some double digits growth, a 10% or something like that. In these small ones or small to medium ones, you can have triple digit growth in a good year. So, you got to diversify your portfolio and things like that. But for the average wholesale investor, where it's a family office or something like that, they are actually quite hungry to get opportunities to invest in those small companies because they're actually quite hard to come by. And so they might want to balance their portfolio. They might have plenty of the bigger kind of safer ones, but they actually want to kind of get exposure to the smaller ones, either because they want a bigger return or because their family office, they want to put their money to good use to support female founders or indigenous founders or green climate technology. There may be particular niches that they actually want to put their money to a cause, impact investing.
Yeah, and I guess that's why with a lot of traditional investment portfolios, you'd see a lot of plain vanilla traditional asset allocation between stocks, bonds,
Yep.
cash, fixed interest, all that sort of stuff.
Yep.
But when we think about asset allocation, we often just think of the main ingredients. But if you're looking for better than average performance,
Yep.
sometimes, not all the time, but sometimes one of the best techniques is just to get something that's off the charts in terms of risk,
Yep.
but still that you understand fairly well, and include a small allocation to that.
Yep.
And that's, I guess, where how to get those investments is the problem to solve, because there's very little financial incentive for the big players
Yep.
to solve that problem, right?
Exactly.
Okay.
And another example that would be like the bond market. So, example, you can have bonds from a private company or a public company or even a government. So, in New Zealand, the New Zealand government basically will sell these bonds, and they're an IOU for a fixed period of time, and you'll get a certain interest payment every year or so, and then you'll get your principal, the money you put in, back at the end. It's a very common way for governments to raise money. If you were to look at one asset that is the most kind of disjointed and dysfunctional, it's probably bonds. So for an individual person that wants to try and buy a bond, it's very, very, very hard. Even if you meet the wholesale criteria and things like that, it's because the bond market is just, there's a few people that buy the bonds and sell them in kind of more old-fashioned ways, quite hard to get access to.
So the broker dealers kind of monopolize that space.
Yeah, and if you think about it, that should be the safest investment in New Zealand. It's backed by the New Zealand government as saying, I'm going to repay this. So why is it so hard to get access to that? It's a lot easier to get access to public shares. We see that as a really big opportunity as well to help bring those into the digital age. And nothing that we do, we are the very, very first ones in the world to do it. We're just taking technology that's been done elsewhere and bringing it to this market.
Yeah.
So the Hong Kong government released digital bonds like 2 years ago, a green bond that was on the blockchain. The capability is there. It's just having people within the system understand the benefits and then being able to connect the investor with understanding what the opportunities are.
Okay. Okay. So thinking about what is right now, thinking about bonds like what you just mentioned or shares, what are some of the areas where everyday investors are being let down?
I guess there's kind of two ways. There's pieces of that ecosystem that are critical for the old infrastructure, but if you have a faster infrastructure, you don't need them.
Okay.
So basically, you can disintermediate or eliminate the need for something like the clearinghouse by having something settle instantly. Because if you have the buyer and seller transact instantly, then you don't need the custody, you don't need the kind of the clearinghouse. So you're not being a cowboy and saying, hey, we'll get rid of them. They were really important for the older system, but in the new system, they just won't necessarily be needed.
Can you just break the clearinghouse concept down a little bit more for us?
Sure. So let's say the current status quo is, let's say, a T+1 day. It doesn't actually matter how long it is. Even if there's 1 day between when an investor gives their money and when they receive the assets in their account, even if it's only 1 day, you need to have parties in that process to guarantee that it's going to happen. If one side backs out, they jump in to cover it. They make sure that the money's in a safe place, no one can do any funny business. All those pieces are needed to make sure that that system is trusted.
So it's kind of like a house transaction where you would agree to pay a price, but then the settlement date might be 30 days into the future, for example. But meanwhile, the seller of that home, the vendor, has gone out and bought another home.
Exactly.
So in this context, you can't have that situation where settlement can't occur, and that's why that clearinghouse is so critical, right?
So important. But if that transaction happens instantly, then you just don't need those funds. In fact, it's even more transparent, because if that transaction was instant, but on a digital ledger that was public, and you can see the history of every single block that's happened, which is what the blockchain is, then it's really clear, and there's a single source of truth of what happened and what didn't. And you can use software code, a smart contract, to make sure that that transaction happens. In other words, if one person gives their part of the deal but the other one doesn't, it doesn't happen.
So we're talking about a smart contract here, right?
So it's atomic settlement is the technical term. That's when it either happens for both parties or it doesn't happen at all. It can't happen one way. And then we're moving into a trustless system. And it's not that you don't have any trust at all. Of course, you need lots of layers of trust. You need regulation. You need all those things to protect investors. But just on this one transaction, it can be trustless. And then that way you eliminate the need for these third parties, and you eliminate the fees, because each one of these third parties, while they serve a function in the status quo, they also extract a certain fee. And that could be 20 basis, 0.2%. It could be even higher. It all adds up over time. So for the little investor that's transacting small amounts, that's actually quite problematic. And you will know more than most that small changes at the beginning of a long portfolio, they compound over time. And so it doesn't really impact the big players that are transacting millions of dollars. The transaction fees are infinitesimal. But if you're, buying $2,000 worth of shares, it does. And like you gave the example of Sharesies. I love Sharesies. Sharesies have done so much for the New Zealand public to get access to, shares and stocks. And I think their user interface is fantastic. The challenge Sharesies have is that they still need to settle on the old infrastructure. So even if I can go on to Sharesies, and I am a customer, I love their platform. If I buy $5 worth of shares, great, that's in my account, makes me happy. They still need to figure out the back end and make it all work. And that's quite tricky, especially in a small market like New Zealand. Our kind of approach is, if we can actually look at the actual technology, the infrastructure, the pipes, the plumbing that these transactions are happening on, we can reduce excess third parties clipping tickets, we can make it more transparent, and we can make it very, very fast.
Okay. So right now, somebody's probably listening right now, or hopefully a few people listening, right? I know my mother-in-law's listening, so that's the most important thing, but there's probably a few people listening to this, and they're wondering, when we say that we can make things happen faster, there's no way that could happen faster in the current system, right? Like, we're not just talking about speeding it up. We're talking about completely replacing those rails with new digital rails that happen at the speed of light, basically. And so to get from there to there is not a gradual change. In fact, that would never evolve. Traditional finance will never evolve to get to this space. This is actually a quantum shift, qualitative shift, completely different rails altogether. The distance between there and there is light years away. How are we going to get there?
The biggest players are generally not in a position to do step change shifts in technology, because it means kind of breaking down their current system that is working quite well for them. The innovation dilemma is that usually it's small companies that come in and find a niche and expand within that niche. So it's kind of what we're doing. But if we think, people often use the term rails, and it's just like the analogy of like train rails. So if you imagine, an old dirt track, and you're taking, your wagon versus I don't know if you've been on the bullet train in Japan. It's just like, oh my goodness, you can get so much done so faster because it's running on infrastructure that moves faster. And so, when we compare the traditional finance world, which is kind of servers and lots of different databases, and it all kind of comes together to protect investors, like it's doing its core challenge, which is to compete and allow the capital markets to work. But it can definitely be a lot faster. And to do that, you actually have to start from scratch and build things on a distributed ledger, where you've got transactions that can happen instantly, and you can keep track of where everything is. So a distributed ledger, for those that aren't familiar, would be the example would be if you imagine like Google spreadsheets, Google Sheets, and it's all around the world and different people have it on their computers. But because of a really clever cryptographic mechanism, you know for sure that people can't tamper with it. If it's on a distributed ledger from scratch, then you can know at any point in time from now back in history who owned what. And there's a single source of truth, and that is the truth, and that's it.
And it's distributed widely enough to create kind of like a backup, infinite backup sort of thing.
A backup. So there's not one centralized point of failure. That allows us to get rid of that. So we talked about how going digital on a distributed ledger, you can get rid of clearinghouses and custody. We can also get rid of the share registry function of who keeps track of the shares, because we can keep track of that as well. So there's three, and there's actually more, but those are the three big intermediaries that you can kind of bypass. And it's not at a compromise, it's actually
an enhancement.
It's an enhancement. And it's actually, we talked at the beginning about this opacity, this blurriness of who owns what. Well, we're actually shortening it right up. So in the purest sense, it's capital markets cut right back to first principles. You've got the buyer of the digital security and the seller, and you allow them to come together to transact. And that's actually a lot purer than all this kind of steps in between.
Right.
And you know who owns what on chain. Of course, the identity of people, it's all encrypted, but there's a single source of truth of who owns what. And what was really important as well is the technology to catch up to allow people not to be able to lose those assets.
Right.
So we all know, anyone who's heard of crypto, the key phrase is, if you lose your keys, you lose your crypto.
Yeah, not your keys, not your coins.
Not your keys, not your coins. So if you put your life savings into Bitcoin and then you just lost the private keys to that, there's no helpline to call, that's gone forever, and that sucks for you. That's not going to work for securities because that just doesn't work. And so the technology had to catch up. And so the technology we use is that the issuer, which would be the company that issues the shares, they have full control over those digital shares for the entire lifespan. So if the person loses their access to their wallet for whatever reason, they can prove their identity and they can be transferred back to another wallet.
I see.
Because by law, the shares have the same property rights as paper shares or kind of existing infrastructure shares. So the shares don't belong to you, the person. So if you prove your identity, then you get those shares back.
Right. So the company itself that is making the share offer is the one that maintains that single source of truth?
Potentially, but at the moment, we are the agent for all of those. So in the future, I think big companies will do that themselves in-house. And they'll have a person that's dedicated to that. We're at such an early point in the stage that we have to basically be each player of that ecosystem. So we come in, we work with a company, we help them issue those shares. We are the marketplace where we can buy and sell them. And we help service those shares. So we can do dividend distributions, we can, shuffle them around if people lose their wallets, things like that. So we do the whole package to start with. But
as time goes on, you'll find your niche, and so other players will probably also come into that space and specialize in just one function. But the difference here is that they're not necessarily building a business. Well, they might be, but really they're building the technology stack to fit out this new digital world, right?
Just like when websites first came out, you would have companies that just build websites, but most of the time these days in a corporate, they'll handle all that themselves. So they'll do their own website, everything in-house, because the technology is so much easier to use. We would love to see other companies come in to help bring assets on-chain. We can call them different words, on-chain securities, digital shares. That process of meeting with a company in the real world, figuring out what they want. And
like an investment banker type concept.
That process, we will be the only ones to start doing that, but we actually want to help others do that as well, because it's our marketplace we want to be thriving. Getting assets on, we want as many as possible. In fact, I would love to have someone who, for example, is from the art world, understands the art world, and they want to work on digitizing shares of big art pieces. And we'll have them on our marketplace, but I don't have the connections to go into the art industry and say, here's this great idea. They're like, who are you? And so you'll have people that develop these niche offerings in certain areas. Our goal is just to try and be the biggest, or if not the one of the biggest marketplaces where all the good stuff happens.
Okay.
That's our goal.
Okay. So let's talk about this a little bit more. When things become digital, I guess that's when everything can change, right? Because that's when code becomes law rather than processes and policies and procedures and all that sort of stuff, right?
Yeah.
So when we kind of look to this digital future, you can kind of imagine what it looks like when it's all there, but it's going to take a while to get there. And you mentioned with DSG, you're kind of trying to build everything all at once, but some parts of it will probably be manual, kind of like the current system works, until the tech stuff kind of builds out around it, right?
Yeah.
What is the template that you're following? Is this happening elsewhere in the world? And if so, have they gone about it in the same way as what you're doing?
Yeah, the hype around tokenizing assets or tokenization of real world assets, it's actually kind of more 2017, 2018. All this excitement, people could see what the vision was, but the technology and the regulation hadn't caught up to delivering it. So there's this big slump, the Gartner hype cycle, the reality kicks in, and then lots of projects disappear, but some of them keep working on, and then over time there's a few different type of kind of digital token standards. So set recipes for a digital security, which is a digital bond or a digital share, a set recipe for what that is that can be used over and over and over again. And so we're using kind of arguably the most kind of successful one. It's called ERC 3643.
Just rolls off the tongue, right?
Just
ERC
like that.
3643.
It's like music to your ears.
Yeah.
So ERC is the Ethereum kind of token standards. So it's just a particular recipe that's been designed just for digital securities. And that's already been used around the world for the last 3 years. 28 billion euros of assets around the world. So we are just introducing this into our local market, which means that we're standing on the shoulders of those giants and using a recipe that's been battle tested, security audited. It's open source as well. So it's this open source interoperable standard. And if we cast our mind back to 2018, 2017, one of the problems was all these companies came up with their own special proprietary kind of token standard, and they all fizzled out, because the only way you replicate a global capital market is by having a system where companies and countries can talk to each other with the same language. And if you go back to the 90s with the internet, TCP/IP, that was a uniform language that everyone could understand. And so everyone from the computer manufacturers to the software, everyone knew the language to write things in. And so it all worked. It was interoperable. And that's what this standard that we're working on is. So when we look at one of the big exchanges that is successful in the US or London, we don't see them as competitors. We see them as ecosystem partners, because we are owning the regulatory space in our region. The potential is, and the conversations are already happening, to be able to take their assets that would work in our market and we list them in our market. And we follow all the regulatory things in our market, and so we almost become a distributor for them, and vice versa.
Wow.
So the connective tissue between the countries is there to avoid these little pockets of capital, pockets of liquidity, which has historically been a problem for the space.
Sure. So we're talking about potentially New Zealand startups would get a much broader access of capital coming into it,
Yeah.
and vice versa.
Yeah.
New Zealanders will get much easier access to opportunities and investments. And we don't really think about the nation state piece too much, apart from making sure that you're compliant within the regional set of rules that you have to follow. But that's just all code anyway, right?
It is. And you can hard code, like, for example, I should make it clear we're only dealing with wholesale investors to start with.
Yeah.
And so for your listeners, that's a certain category of investor that has a certain net worth or a certain professional experience, that they're to a point where the government can say, hey, look, you know your stuff. If you want to do something a bit more risky, we try, you've got the money to lose, it's fine. Whereas the regulators are typically more focused on the everyday retail investor, because you don't want people losing their life savings on something that's a bit of a gamble. And so our journey to be able to offer retail services is 2 years away. Lots of licenses we've started, but it's going to take a while. But we can hard code into the platform, okay, what defines a wholesale investor in New Zealand versus Hong Kong, Singapore, Australia. And so we can, it's not, I wouldn't say easy, it's still tricky, but it's a hell of a lot easier than the current system, because at least with the current system, at least with eliminating border frictions, if you've got a separate database in New Zealand versus Hong Kong, then they're not going to talk to each other. Well, we've got the global, the distributed ledger is global, so we don't have to worry about whether technology can transfer. It will. It's about getting the regulation right, which is still 50% of the challenge, but it's nice to only have half of the challenge rather than
than the actual, how do we actually pull this off, right?
Yes.
That part's done.
Exactly.
It's just all the other part.
Yeah.
But I guess the more you spend time looking at this, the more you look at what already exists with a certain degree of disdain, or at least impatience, right? Like, when are people gonna finally realize this isn't good enough anymore? Do you ever kind of get those thoughts?
The frustration comes in where you've got people that are in the economy that aren't able to grow because they can't get what they need. The NZX, for example, they're all very similar. They're doing what they do well, and they will continue to do that. But it's what they're leaving on the table that really excites me, and solving that problem. And I know that over time, if we do things right, the line between what is our value proposition versus what is kind of the public one will shift. Because if let's say we support an early stage startup to do their first seed round and then their Series A, and we help them over time, they become digital by native. And so it makes sense for them to continue to stay on the digital journey.
Yeah.
And so what we're seeing is the very first step of taking something analog and moving it to digital. And don't be mistaken by moving something electronic. When we look at the banking on our app, it's electronic, and it looks all very slick, but at the back end, it's still on the old rails. It's not digital, if you're going to be fussy about terminology. Once you take something that has been analog, and we'll use an example of music, the first shift was LP records to a CD. And that's actually not that exciting. Yeah, it's a bit smaller. You can put some more songs on. Sounds probably a little bit worse, actually, And that was just the first boring step. But you needed to, once you get from analog to digital, then you have songs in a digital format. And then what did that allow? Well, that allowed the iPod to put 1,000 songs in our pocket. And then now, for $15 a month, I've got access to 100 million songs on Spotify. You can't get from LP to that. You've got to go through the different steps. So by us issuing digital shares and digital bonds, it solves some problems, for sure, for some groups. For others over here, they probably don't kind of care. But what that does, it unlocks so many other opportunities, because it allows lots of other things to happen instantaneously as well.
So when this happens, it'll probably it'll start with smaller pools of money, or do you think that it'll lead up to a certain point, and then all of a sudden everything now converts to digital assets, like do you think that everything pre-existing will convert at a certain moment in time, or will it just slowly phase out?
I think it will phase out over
Okay.
time, and in any marketplace, participants will go where they're getting the best deal. So at the moment, because a digital marketplace has so many less people clipping the tickets, the fees are an order of magnitude lower. Like I'm talking about 10 times smaller. The only people that care about that now is small companies. Like, oh, great, we can do a listing and it's only costing us $5,000 instead of 50. But as the benefits start to be seen, you'll get more companies, and it's not exclusive. If you go with a digital listing, it doesn't mean you can't go paper as well. So you can do both. And so you'll just get kind of people migrating over to the faster, better platform, especially in like any marketplace, it's the buyers and sellers. If you get it right, it becomes like a flywheel where it just grows and grows and grows. So if you get really cool products, you get buyers for them, and then you get more buyers, so you get more cool products, and it kind of goes in a cycle. But also, we're in a fortunate position to have the perfect timing from a tailwind perspective, because you've got huge companies and kind of incumbents in the US, the BlackRocks, the Franklin Templeton. They are launching digital asset type of offerings in parallel to what they already have. So they're smart enough to say, hey, look, I've got a subsection of clients that might be into this. We'll make something for them over here. And so by doing tokenized treasuries, digital bonds, in other words, or products like what BlackRock is doing, it provides a solution to people that want that offering, that yield. And also the other tailwind we have is it's becoming more and more normal for people to hold digital wallets. And, we hold digital wallets for all kinds of loyalty programs and things like that. But, the New Zealand government is consulting again on what a digital cash would look like, a central bank digital currency. You see how it will become very normalized to hold digital currency on your phone or on your device. And so it's not that much of a leap to see, in my portfolio, I've got these New Zealand digital dollars, and I've also got my shares over here in my bonds and whatever. So we're quite fortunate to be in a good tailwind there as well.
Yeah, man. Well, I'm just getting glimpses of what you're describing, just trying to see it.
Yeah.
It's pretty big, isn't it?
It is.
It represents quite a massive transformation in terms of how we live. Probably not too dissimilar to the iPhone, how the iPhone made us so much closer to the internet, whereas the internet existed, but there was friction getting our bodies to a position where we can interact with it. Now it's just always in front of us all the time. And so what you're talking about is everything that we own that has value through our digital wallet will be so much closer. And what you're talking about is just building out a small portion of that, which means that people can have a lot of their investments just in their own wallet. So no need to log into a different account for that reason. It's just in your digital wallet, which has everything else, including maybe some of your art, maybe your ID, your passport.
And so essentially you're actually self-custodying your own investments and wealth. And that's scary at the moment because self-custody means the risk of losing it.
Exactly.
Stuffing it up.
Yes.
But you don't have that in this world.
Okay. So why? Why is it not scary and dangerous? Because you might lose access to your stuff.
If you lose access to it, you can contact the issuer and they can transfer them back.
Sure. Okay.
So we're kind of in a space, you could call it like permissioned DeFi, maybe like that. So if you imagine, for your listeners that know a little bit about decentralized finance, you've got all these really amazing things that you can do, but you can also get scammed and you can lose your keys, and there's an element of risk there. The user interface is really kind of tricky. If we take those same building blocks, but we make it so that at DSG we do full know your customer on every person that comes in. We're doing sanction checks to make sure they're not a Russian oligarch. We're putting all those traditional finance checks and balances in place, the oversight. What we're talking about is the peer-to-peer frictionless transacting of a DeFi platform like Uniswap,
Yeah.
but you're transacting in real shares or bonds with digital
Sure.
dollars.
So there's a match that's already allowable.
Yeah.
Like the Air New Zealand shares with
Yeah.
New Zealand dollar stablecoin.
Yeah.
And that's what you mean by permissioned.
Yeah,
DeFi,
and permission.
right?
Not everyone can just go in and bring their funds from who knows where. You've got to enter in this mechanism that checks who everyone is, because you have to have that. You will always have to have that in regulated markets for good reason. But we're allowing the experience of buying and selling using the super efficient mechanism, which is Uniswap. For people that know DeFi, it's an automated market maker, basically. So the smart contract, the code matches the buyer and the seller, and the price of that is dynamic depending on how many buyers and sellers there are. The word is perfect. It's an automated market maker.
Yeah.
Whereas in the incumbent system, the NZX would run, they're the market maker, but they're not automated, and therefore they need to take a fee for that.
Got it. So once you're in that ecosystem, it's all cool, like, because the KYC and the AML, that's already being done. Does that mean, so how does that work, just from thinking about my wallet, my digital wallet, which is a carrier of all my wealth? What does that mean does that mean that I have to whitelist that, right? I have to make that safe and compliant in some way. Is that correct?
Yeah. For what that means now, today, is that we or whoever it is works with a company that specializes in KYC and onboarding and biometric. You move your head for the video, and you take a photo of your passport and all that kind of stuff, and you run a check on everyone every week to make sure there's no global sanctions. All of that needs to be in place for us to be trusted by the system, and that's great. That's good. There's lots of stuff that happens in the pure decentralized permissionless space with DeFi, and philosophically I see lots of value in that, but that will never be congruent with a legal kind of country. It just doesn't work.
A nation state stuff, and they ain't gonna have a bar of that.
No.
This is something that's kind of like in between.
Exactly. You're trying to get the rails, the train tracks of something that works really well, but the oversight and the checks and balances to make sure that everything's on the up and up.
Okay. Again, we're talking about the future, but does this already kind of exist in some format where there's this permission DeFi thing going on?
There's experiments happening, but it hasn't happened at scale. So everything takes its steps. So the first step we have is just operating the marketplace. And it's just you can buy them on the primary market, which is basically for the first time you buy them in your wallet. Very soon we'll go through the process to be able to unlock secondary market, which means that peer-to-peer, let's say you buy some shares and then you want the money for something else, you can put up an ad on the platform, hey, I want to sell these, this is my price. Someone else can come and transact peer-to-peer.
Right, and it just happens automatically.
It happens automatically.
Yeah.
They have to have their wallet whitelisted and KYC'd, of course.
Yeah.
And our platform just facilitates that, make sure it happens properly, and then we get a tiny fee from that.
Got it. So it is peer-to-peer. So I own Air New Zealand shares. You own Main Freight shares. And I want to buy some Main Freight and I want to sell some Air New Zealand, right? And it just so happens that, obviously there's more people here going on in this story.
Yeah.
But that doesn't go through an app dealing with some people who are actually literally working on computers, who are sending emails sometimes or updating databases elsewhere, and then it sits in a holding pattern, and then it settles a couple of days later, and then you see it in your account, and then it's not there. You call up, and what's going on? None of that. It's just peer-to-peer interaction between code, and then instantaneous speed of light.
And so one person would have a stable coin in their wallet, the other person would have the shares, and they would swap. Of course, we're at the point now where not everyone has stable coins in their wallet, and so our platform needs to be easily to access now. So lots of people now, what they'll do is they'll see something they like, they'll say, yep, I want to buy 10,000 of that. It pops up with a bank account. They transfer the money the old-fashioned way. Once the funds clear, and for that time, those digital shares are locked away for them.
Okay.
Then the money clears. When we say, yep, it's cleared, we release it. Those shares are then minted or created for the first time straight to the buyer's wallet.
Okay.
So even if you want to pay in fiat, New Zealand dollars, how we used to, there's still no custody needed, because I'm not taking your New Zealand dollars, holding it. Actually, what's happening is the money's being transferred, and the shares, they're not even kind of being held by someone. They are made when they are needed on demand.
Right. So the shares are actually minted on demand.
Correct.
New Zealand dollars is going directly to where it would normally go.
Yeah.
But it's just the process on the other end is different.
And even though there might be, in New Zealand, probably 4 hours between banks to settle that, but even if that's stretched out over the weekend or whatever, it's not actually like the old system of clearinghouses and custodies, because it's just about making sure the money arrives and then the shares are then released.
Okay.
So it's, even when people use New Zealand dollars, it's a lot faster and more transparent. But what will happen over time is people will just transact with digital dollars, otherwise called stable coins, or digital cash is what New Zealand Reserve Bank is calling it. And in that way, it's instantaneous. It's New Zealand digital dollars for securities, instant transaction.
So if you want to use the old-fashioned way with your fiat currency, go for it. But it's going to. So that's what's in existence now, right? Like, as soon as you're live, you'll be able to do that. But the easiest way for people to kind of get their head around this is that this will probably kick in first for brand new companies that are listing via the DSG platform. Can you talk me through that?
Yeah. So if a company, we might come across a very, very early stage startup, or even a more mature small to medium business that wants to kind of expand over time, they both need money to do so. And so let's go that the small to medium enterprise, let's say they need $5 million to build this new warehouse to start shipping into a new market. So they work with us. We set up the parameters of that raise. So, there's going to be, each token is going to be $5,000 worth, or whatever share price. You can set all that up and calibrate it. And then that goes live on the marketplace. And then investors, they read the due diligence of this company. Yep, I think it's got potential. I want to invest in it. They do. The company takes those funds and helps grow. And the investors now own a piece of that company and a piece of its success and future cash flows. 101 of financing. What gets a little bit more tricky is, and this is the problem we came across, is for a very early stage startup, how do you put a value on that startup? Often it's pre-revenue. They haven't made any money, because we haven't. How are you going to put a price on that to be able to sell shares? And this has been a problem for decades. And so the solution that's been used for 12 plus years is something called a simple agreement for future equity.
Safe.
A safe. And so company, angel investors or VCs, they would provide money up front. You would sign this simple agreement for future equity. And then later down the process, when that startup has gotten a bit of revenue and they're doing another fundraise, this time with a value, they've had their price round and everything, then the money that was first put up by the investor gets to buy shares in that round at a discount or some kind of benefit to reward them for leaving them early. Right?
So they buy when the price is unknown, with an agreement that when the price is known, they get a discount on that price.
Exactly. And that works really well for startup, because they don't even have to try and make up some arbitrary finger to the wind price. It's like, this is what we're doing. This is our mission. If you believe in us, back us. The problem is that only really works at the moment with big VCs that write big checks. So in the US, very, very popular. You've got, VCs will often write $1 million checks plus. In New Zealand, we just don't have that type of venture capital scene. And our angel investors, they might want to write a $5,000 check. And a startup that's trying to raise $2 million, well, they can't work with 50 angels. It's going to be a complete admin nightmare. And so we decided, okay, if we put our thinking caps on, how can we solve this problem for ourselves and then for others? And so our solution was we take a special purposes vehicle company, SPV, and that SPV has a safe agreement with DSG. And it's a single safe agreement for $2 million US, for example. And so that company has the one agreement. And then that SPV, the shares to that are sold on our marketplace. And so for as little as $5,000, an investor can buy a share in that SPV, which is basically owning a piece of that contract.
So the special purpose vehicle owns the safe agreement.
Correct.
And then it's basically fractionalized. Well, shares in the SPV are listed on the DSG platform.
Exactly. And then so what will happen is investors will buy those shares. The funds will be used to help grow DSG and grow to, help us get to a point where we do a good price round at a higher valuation. And then what will happen is when we do that round, the safe agreement will be triggered and the equity, the shares in DSG, the company, will be distributed pro rata to the shareholders in the SPV.
Okay. So this is like pretty meta because we're having a conversation around how this works, but this is actually how DSG is raising funds as well right now.
We're being the guinea pig.
Yeah.
Which is great. We get to kind of battle test it and see where the sticking points are.
So we know it works in theory, but you're actually experimenting on yourself first. You're taking the serum yourself first before you mutate.
Yeah.
And then if it works well, but we already know it's going to work. But it makes sense because you also need to do a capital raise, and it's probably the most efficient way to do it. Well, if it isn't, then why are you in business, right? Like it kind of has to be.
Exactly. So we'll be able to proof this new mechanism, and of course, Kiwi Angels are super excited about it as well because let's say they've got $50,000. At the moment, they'd have to basically work with all kinds of startups and then maybe write a check for one of them. Well, now they can actually put 5,000 into 10 different startups, which diversifies their risk at no extra kind of admin cost. And also the startup isn't having 50 investors calling them up every week saying, what are you doing? Like, when are you going to make profit? There's a level of separation there. And we're using building blocks that have already been proved. Everyone knows the safe agreement, super trusted. Everyone knows what SPV and shares are. It's the combining the two. I haven't found anyone worldwide that's done that yet.
Really?
So this is something that
this is a first.
This is a first that I'll be love to be proved wrong, but it seems to be first. Yeah.
That's pretty cool. So taking existing building blocks, putting them together differently. Well, that's true. That's as close to genuine creativity as you can get.
And the benefit of course is, let's say DSG. So let's say people buy we call it the T-Safe, a tokenized safe.
Okay.
T-Safe. Let's say people invest in that T-Safe. In a year's time, we've hit lots of great milestones. We're in the news. We're doing well. We're getting a bit of revenue. We haven't done our price round yet, but our profile's going up. That investor might say, hey, look, I want to buy a boat now. They could sell that T-Safe on our secondary market for conceivably, with market price discovery, higher than what they bought it for. So there's some price discovery on the secondary market so it's essentially bringing liquidity to kind of small startups
at an earlier stage,
right? Which is the one of the things that stops people investing in early stage startups is that you might be 5 years until you see anything, and it's locked up. It's not liquid.
Sure.
So we're bringing liquidity to this asset class as well. So we're hoping to be part of boosting this entire innovation scene in New Zealand and helping more startups get funding, helping more angels put their money to good use. And so again, you've got the first principles of capital markets. Angels that have got money to invest, and startups, or in this case startups, that want to put that to good use, and we're helping connect them in a way that hasn't been done before.
Sure. Yeah, better diversification, better liquidity. It's lower cost because you're disintermediating if you
Exactly.
change,
Yeah.
and lower barriers to entry, I guess, eventually, right? Because you when it's more in the retail space, I guess that's more applicable, right?
Yeah. And so when we get to the size where we either get a license to go retail, or we can put some of these into a retail offering, like you might have a wholesale pie fund, and then you might have a retail pie fund that invests in the wholesale pie fund. But the retail pie fund has all the disclosure stuff. It goes above and beyond with that side of things. So there's a way to package things into a retail friendly, but we just want to go from the start. We've always said we just want to go full regulated. We want to play by all the rules. We want to jump through all the hoops because we're in it for the long run to change things rather than trying to find loopholes and kind of quick fixes.
Got it. Okay. And it might be the same thing as permission DeFi. No, it's not. Talk to me about the zero knowledge proofs and just the intersection.
Zero knowledge proofs, for listeners that aren't aware, is a really clever thing you can do in cryptography and blockchain where you can prove a fact without actually showing the underlying information. So the example would be you can prove to the bottle shop that you're over 18 without actually showing them your date of birth. So that in this world means that you could remove one more centralized entity. At the moment, we have to rely on a company to be able to do the KYC and prove who people are, and the link back to that person's wallet is all encrypted, but there's still the centralized, there's a risk there, right? If we can get rid of that all completely and we can prove that you are who you say you are, or that you are something using code with zero knowledge proofs without telling the world who you are, then that's a 5-year step down the future. Would be even better.
Okay. You can see some short term and some medium and then long term things that will manifest in this ecosystem.
Yeah.
But meanwhile, traditional finance, the legacy system, is seeing that this is getting bigger.
Yeah.
And what begins to happen then?
You get attempts to try and integrate blockchain elements. The Australian Stock Exchange went through a big program, tried to do this, spent a lot of money, I think 10 million or so, maybe even more, and then end up scrapping it because it's just not too hard, and it's distracting from their core business. So you'll get the really clever ones with good leadership spinning up kind of other brands in the market, but you might have a big player kind of start a small cool version like a neobank type of thing,
like a skunkworks type thing.
Yeah. So that could be it. Or you'll find, and this is what I think will probably happen, is that over time the big players will realize they missed the boat and they'll gobble up a whole lot of the early infrastructure providers.
Sure.
And hopefully you want that to be acquire to integrate the technology rather than acquire to shut it
extinguish
down.
It. Yeah. Because that's the other strategy, right?
Yeah.
But I guess if this is happening globally,
we're past that point now.
Yeah. Because if it's clearly better and people are starting to wear, and that's kind of what I'm hoping to do is not only educate myself, but hopefully other people will realize that this is actually the standard by which we should measure where we're at today.
Yeah.
Because this is mathematical. This is open.
Yeah.
It works in theory, and we can see little pieces of it working.
Yeah.
So we know it's just a matter of assembling it.
Yeah.
But anything that's not that means that it's just not there yet. It's not as good as. So why are we putting up with things that are not as good as? We need to keep on demanding better and better. And I guess the providers of those other services probably need to realize that that's what consumers will eventually start crying out for as well.
Yeah, hopefully.
Once they know what it is.
Yeah. Like I said, the current system will probably continue to work really well for big players. Yeah. But for smaller, like I've got an ASB securities account. I've used it for many years. It's good for what it is, but the fees will kill you with small transactions. Yeah. And so for me as a small investor, it's really tricky to do that.
Okay. Fast forward 10 years. So we're 2034 now.
Yeah.
What does it look like when I'm an everyday investor trying to build my portfolio in individual shares or funds
Yep.
What does it look like in this new world
Yep.
where I'm actually investing in digital bonds or digital shares?
You'll have everything be digital and on-chain for transparency and fee reduction. You'll have robo-advisors and kind of AI optimized portfolios, and that'll be a combination of real-world experts and augmented by AI tools as well. And people will, when you have sovereignty of your own investments, that means you can do clever things that at the moment only the big boys can do. So if you look at the billionaires and even multimillionaires of the world, they often don't sell their assets, they borrow against them. Because if you borrow against your share portfolio, then borrowing isn't a taxable event, right? But selling the shares is. So if you have a $100 million share portfolio and you borrow, you borrow some money, you just borrow from that and use those shares as collateral. It only works at large scale in the traditional finance world. But with the power of DeFi, you could borrow against your $1,000 portfolio of shares, and it just means that it will have to be over collateralized. So let's say you might be able to borrow $100. Like let's say you need a bit of a payday loan, right? Well, instead of going to a loan shark who will charge you so much interest, you just borrow it against your portfolio you have, and the mechanism to do that is already there, built, ready to go. And so you'll see people be able to have access to lots of these interesting tools, but at a tiny, smaller level. And then that will ripple out to bigger and bigger and bigger kind of people.
Which is when it starts to really blow my mind, right? Because I understand roughly how over-collateralized lending works in the crypto space, but when those crypto assets aren't just cryptocurrencies, but those are actually tokenized real-world assets, then that means that mom and dad's house that you've just inherited and you've gone through a process of tokenizing it and put it on chain. Now you could effectively borrow 50% of its worth and put it to Bitcoin, then borrow 50% of that, and then keep on going. I'd love to dig into that more at another stage, but that means though that we're speeding up, aren't we? We're speeding up the flow of money within systems, which means that if dollars can be in more places at once, it's almost indistinguishable from the quantity of money. It's the quantity theory of money, right? Where if there's a lot of money, it can build up like pressure, right? But if it's not a lot of money, but it's moving around really fast, it's the same effect. So I'm just wondering if in this new ecosystem, are we going to be speeding up money really fast? And then again, I'm thinking more macro, but what implication does that have around monetary policy? Which then has a feedback, because if the currency that you're using is now regulated by a central bank using CBDCs, then everything is just going to happen so much faster, isn't it?
So the velocity of money is definitely speeding up when you get on digital rails, because already you've seen the success of the Easy Crypto team's NZDD stablecoin, and that is programmable money that can move at the speed of light internet around the world. It's been successful and will continue to be that way. There's a demand for digital dollars, and they fit perfectly into ecosystems like ours, and we're just one of hundreds that are building these financial tools for the digital realm. And having digital money that can be split up into 8 decimal points. I wouldn't be surprised if in the relatively near future, when digital cash becomes normalized, then you'll see your pay won't be sent every fortnight into your account. It'll be streamed minute by minute into your digital wallet. Because that's possible now with digital currency. And what have you done there? You've mean that you haven't got this feast famine, of being paid sometimes every month, which is quite tough if you're budgeting. But all the accounting piece of having people doing payroll, you could have that all done as smart contracts as well. So you're using code in place of humans and human error. And it's not that you're necessarily replacing jobs, but you're just allowing people to do more higher level thought things than like banging in and making mistakes.
Yeah.
Yeah.
What comes first though in this new world? Because I look at this 2034 picture that we're painting here of how things are working.
Yeah.
Money's moving around faster, monetary policy is moving faster. There's all sorts of innovation everywhere. But what comes first is, does everybody need to kind of get comfortable with the fact that they're probably going to have to download and start using a digital wallet of some sort?
Yeah. For the average person who they've got busy lives, they've got problems to worry about, they're not jumping on and tinkering around with DeFi in their spare time. They've got other more important things. People generally only make big changes when they are forced to, or when the solution is an order of magnitude better or cheaper than what they currently have.
Sure.
In this particular situation, it will be when your employer pays you in that, or if there's this great deal, if the government says stranger things have happened, if you download this wallet and get set up, we'll issue you 500 digital dollars straight away. That is motivating to people.
Yeah.
And then once people change their behavior, it actually becomes ingrained pretty easily. We all take our bags to the supermarket. We've almost forgot about plastic bags.
Yeah.
The teething pain to get there, everyone hated it. But now it's just part of our routine.
Yeah.
And so once people start using this as a normalized means for transacting, that means that it's not as scary to go from a digital dollar to a digital share, whereas going from a piece of paper cash to a digital share in a wallet can sometimes be a little bit scary for people.
Sure.
You've got the early adopters that will be into it, but the kind of early and late majority, they'll be pushed into it a different way.
And I guess this is why whenever I bring up the question with people, or whenever I even just think about it myself, the idea of a central bank issued digital currency can sometimes be a little bit divisive or polarizing. You'll have one of two ideas or around whether it's good or bad. But this part of it, where we think about the actual application in the digital ecosystem, is a really strong case for it, isn't it?
Yeah.
Because now you can kind of understand that when more of our analog becomes digital, it creates probably a lot more benefit than it does harm. However, the harm is going to be so much more, it's going to be so different than the harm that we might have known in the past, because even that will happen faster.
Exactly. And so with this particular central bank digital currency conversation, you've got to have robust checks in places that you're not going to have the surveillance and control over where you can't spend. It very easily has the potential to go into a dystopian place very quickly. And the Reserve Bank is aware of this, and that's what they're consulting on, and being able to have transparency around code and making sure that doesn't happen. I think that's what people are really worried about. People know that it speeds up the velocity of money and makes things better, but what they don't want is, even with the best of intentions now, in 10 years' time, like, you can't actually buy that chocolate because your blood sugar levels are too high. You don't actually have the freedom to spend how you want to spend.
Yeah.
Which is what we have now with physical cash. Yeah. No one can tell you what to do with that physical cash.
Yeah.
We don't want to live in a future where there's no physical cash and everything's controlled and surveilled.
Yeah.
That's the fear.
Okay. And so I guess one of the last things that I wanted to finish on was around this concept of, I don't know if this is the right way of saying it, but stratified currencies, or different currencies for different purposes.
Yep.
And so you kind of touched on it a little bit right there. Maybe there's a place for anonymous cash, which might be physical representations of money, kind of like what we already have right now, or some other sort of digital token that you're allowed to have up to a certain amount for your anonymized purchases.
Yeah.
Maybe there's Bitcoin for your wealth and for moving serious amounts of money around.
Yep.
Maybe Ethereum is the currency that we're using for anything to do with financialized transactions, like what we would do in the investment ecosystem. And maybe other types of assets like Solana in more the tech space or in building space. I don't know.
Yeah.
But do you kind of see that world happening where we have two different types of digital assets, and that bonds and shares, but then we have our currency, our stable coins, but then maybe these crypto assets that we can access today, we're investing in them, but really we're actually holding our firepower or our dry powder in different forms for different purposes that we might want to build on in the future. Is that an accurate picture
Totally.
of what might be?
I mean, that's already happening now to some degree. Maybe not for the average person, for people in, and the paradigm shift is, instead of having different nation states having different currencies, that's what we're used to, right? People might, I want to hold US dollars instead of thing. But what we're talking about now is all these types of currencies or means to transact that are decentralized, they're global, they're not one single point of power, the Bitcoin, the Ethereum, things like that. And so that will only magnify. And the more a country, and I'm not saying New Zealand will do this, but if a country started to go down the more central bank digital currency route that was more surveilling and controlling, citizens will revolt and push away towards Bitcoin. And you've already seen that examples of places like Venezuela where there's just crippling inflation.
Yeah.
People just find a way because you can't shut Bitcoin down. That's the whole value proposition of it. And so now that the genie's out of the bottle, those tools are there for people. So they will do what they need to just to preserve their wealth.
It's great to know, though, that the free market isn't dead for those of you that were giving up. That's good. No, but that's me. But hey, before we finish up, let's just quickly plug this magazine. I'll put it right in front of the camera there so we can see it. Tell me a little bit about this.
So this was something that we started putting together in October last year.
Yeah.
We put it out every quarter, and it's a way for us to demonstrate thought leadership and help people understand the pros and cons and the nuances of digital currencies. Yeah. It's in physical print on stands around New Zealand. I think 84 different points of sale, including 6 airports. But then the digital version gets sent out to about 12,000 finance professionals as well. So it's been a really good way for us to bring people into our orbit that are experts in this ecosystem and interview them and chat to them. And it's been a good way to get people to kind of understand what we're doing and why we're doing it, which has meant people come in and talk to us about listing and other opportunities.
And so if people want to get on the list of just finding out next steps for DSG, do you have some sort of newsletter there that people can subscribe to?
If the best place is the website, so www.dsg.exchange, and you'll learn about all about us, about the platform, and also there's a page there about the magazine, so you can get the latest digital copy for free as well if you want.
No, that's awesome. Thank you very much, Ryan, for coming on the podcast. Really appreciate it. Cool. And we'll catch up with you again soon.
Awesome.
Cheers.